Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Lumen Technologies Inc. Annual Report. Lumen Technologies Inc. offers a wide range of products and services to both business and mass customers globally. The company operates in two main segments, business and mass markets. In the business segment, Lumen provides various services such as dark fiber and conduit, edge cloud, Internet Protocol IP, Voice over IP, managed security, software-defined wide area networks, unified communications and collaboration, and optical services. In addition to these services, Lumen also offers Ethernet and VPN data network services, legacy services for managing cache flow, and other legacy services like synchronous optical network, SONET, based Ethernet, legacy data hosting services, and conferencing services. The company also provides managed and professional service solutions, as well as sells communications equipment. In the mass market segment, Lumen offers high-speed and lower-speed broadband services to residential and small business customers. This includes local and long-distance voice services, professional services, and other ancillary services. Furthermore, the company participates in federal broadband and state support programs to expand its reach and offerings. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to skyrocket. The stock price of Lumen Technologies, Inc. has seen significant growth in the past year, leaving investors and analysts eager to understand the underlying causes. One possible reason for this surge is the company's strategic investments in emerging technologies such as 5G networks and edge computing. By positioning itself at the forefront of these innovations, Lumen may be poised to capture a larger share of the growing market. Another factor contributing to the stock price increase could be the company's efforts to improve its operational efficiency and reduce costs. This might include initiatives such as streamlining its network infrastructure or implementing new management practices. By becoming more agile and cost-effective, Lumen may be able to better compete with its peers in the industry. Additionally, changes in market sentiment or broader economic trends could also be driving the stock price upward. For instance, if investors become increasingly optimistic about the prospects for telecommunications companies, they may be more likely to buy into Lumen's stock, pushing up its value. Similarly, a strengthening economy or favorable regulatory environment could create a positive backdrop for the company's growth. Ultimately, the exact reasons behind Lumen Technologies' rising stock price will depend on a variety of factors specific to the company and the market at large. However, by examining these potential drivers, investors can gain a better understanding of what may be fueling this trend. Lumen Technologies, Inc. maintains a market capitalization of $8 billion, broadly in line with the industry peer group. Lumen Technologies, Inc. trades at a lower price-to-book ratio of -6.98 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 99% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified from the provided summaries. On the growth side, key contributors include the expansion into new segments such as dark fiber and conduit, edge cloud, and fiber broadband, which have seen significant increases in revenue. Additionally, large enterprise, public sector, wholesale, international, and other segments have also experienced growth. On the decline side, certain segments such as harvest, mid-market enterprise, public sector, wholesale, and international, and other have seen a decrease in revenue. Furthermore, business segment by product category and mass market segment by product category have also declined. Other drivers of revenue growth include governmental funding, contract acquisition costs and fulfillment costs, and tax-related items such as cancellation of debt income, indemnification refunds, research and development credits, and change in valuation allowance. Conversely, other drivers of decline include relinquishment of RDOF awards and deferred revenue. The net income of the company has experienced a decline due to several factors. One major reason is the challenges faced in integrating modernizing systems, which have hindered the company's ability to operate efficiently. Additionally, downward pressure on pricing and reduced demand for certain services have also contributed to the decrease in net income. Furthermore, prolonged systemic declines in legacy services have further exacerbated the decline. The profit margins of the company have also been affected by various factors. The increased competition and technological changes have compressed the profit margins, making it challenging for the company to maintain its profitability. Moreover, revenue declines across various products and services have impacted the profit margins, leading to a decrease in overall profitability. The company's financial performance indicates a consistent trend of generating positive operating cash flow. This can be seen through the increasing net cash provided by operating activities, which rose from $2,160 million in 2022 to $4,738 million in 2024. Furthermore, this growth continued into 2025, although the exact amount is not specified. The company's ability to generate positive operating cash flow is also evident in its contract acquisition and fulfillment costs, as well as its operating leases. These sources of revenue have consistently contributed positively to the company's overall operating cash flow. Overall, these indicators suggest that the company is successfully managing its finances and generating sufficient cash from its operations. The company's debt level has undergone significant fluctuations over the past year. While some reports indicate a decrease in total consolidated indebtedness and long-term debt, others show an increase due to refinancing and issuance of new notes. For instance, page 47 states that average outstanding long-term debt decreased by $1 billion, but page 60 reveals that debt level increased by $2 billion due to first lien note refinancing. Similarly, page 79 shows a decrease in long-term debt from $17,494 million to $17,353 million, while page 81 indicates an increase from $8,158 million, 2024, to $1,325 million, 2023. The overall trend is unclear due to conflicting information. Regarding interest expenses, the company has experienced a general decrease. Page 47 states that interest expense decreased by $88 million, minus 6%, from 2024 to 2025, while page 127 reports a similar decrease of $88 million from 2023 to 2024. Additionally, page 79 shows a decrease in interest expenses from $197 million to $149 million, and page 82 indicates a 3% decrease in interest paid, net of capitalized interest. However, some pages provide conflicting information or lack explicit details on the change in interest expenses. And the company's performance varied across different segments and regions. On the positive side, the public sector, mass market segment, grow segment in wholesale, and harvest segment in international and others showed strong results. The mass market segment saw an increase in fiber broadband in mass markets revenue and a rise in adjusted EBITDA as a percentage of revenue from 52% to 56%. In contrast, the mid-market enterprise, wholesale, other segment, international and other, and nurture segment struggled. The nurture segment experienced a significant decline of 18% in 2025 compared to 2024, resulting in a decrease of $458 million. The harvest segment in wholesale and business segment revenue also underperformed. Management's outlook and strategy for the company appear to be focused on several key areas. Financially, the company is expecting significant revenue growth from existing customer contracts, with a projected $6 billion in future revenue. Additionally, management has increased its allocation to emerging markets, indicating a positive view of these regions. In terms of tax strategy, management plans to utilize federal NOLs to reduce future tax liabilities and is closely monitoring evolving global and domestic tax legislation. This suggests that the company is proactive in managing its tax obligations and adapting to changing regulatory environments. The investment program is also a key component of management strategy, with a focus on diversifying assets across various asset classes, strategies, and market sectors to manage risk. This approach has already yielded positive results, with actual gains exceeding expected returns by $219 million in 2025. Debt management is another area of focus, with the company aiming to maintain a maximum total net leverage ratio of 5.51 by December 31, 2024, and further step down to 5.25 by December 31, 2025. This suggests that management is committed to maintaining a healthy balance sheet and managing debt levels. Finally, the company's dividend policy is not currently paying dividends on common stock, but with discretion from the board of directors to declare and pay dividends in the future. Overall, management strategy appears to be centered around financial performance, tax optimization, investment diversification, debt management, and prudent capital allocation. The company has made several acquisitions and divestitures to shape its business strategy. In terms of acquisitions, the company has targeted companies with cybersecurity vulnerabilities or unsophisticated controls, as well as strategic acquisitions that align with its goals. On the other hand, the company has also engaged in significant divestitures. Notably, it sold its mass markets fiber-to-the-home business to AT&T for $5.75 billion in 2026. Additionally, portions of its network were sold in 2023 and 2022, while its EMEA business was sold in 2023. The company also relinquished rights to deploy services in certain areas and voluntarily relinquished RDOF awards. Furthermore, the company has divested businesses tied to IT support obligations and paid $95 million for repayment of funds previously received and remittance of fees incurred. These transactions demonstrate the company's efforts to streamline its operations and focus on core business areas. The company has a history of paying dividends to its shareholders. According to the financial records, the company paid out $-1 million in 2024 and $-3 million in 2023. This indicates that the company has been distributing a portion of its profits to its investors. However, there is no mention of share buybacks in the provided information. The only reference to repurchasing shares is related to Level 3 financing, which includes a change of control provision allowing for potential repurchase offers. Despite this, it appears that the company has not engaged in any significant share buyback activities. While there are concerns about supply chain disruption, the data suggests that inventory buildup is not a significant issue for the company. The reliance on key suppliers and vendors due to operational disruptions or other issues, page 24, may pose a risk to the supply chain, but it does not necessarily translate to an accumulation of excess inventory. The potential supply constraints mentioned in page 25, such as labor shortages, construction delays, and increased investment in network resilience due to climate change, also point towards supply chain disruption rather than inventory buildup. The increase in construction in progress, page 134, may indicate a proactive approach to addressing these challenges, but it does not necessarily imply an accumulation of excess inventory. The data on materials, supplies, and inventory, page 182, shows a slight increase from $146 million to $165 million, which is not significant enough to raise concerns about inventory buildup. The increase in accounts payable associated with capital expenditures may indicate a shift towards investing in the company's infrastructure, but it does not necessarily imply an accumulation of excess inventory. Overall, while supply chain disruption is a concern, there are no indications that inventory buildup is a significant issue for the company. That concludes the financial summary for Lumen Technologies Inc. Feel free to comment below, and I will be happy to answer them when possible.